factors that influence exchange rates. The first factor that influences exchange rates is interest rates. Central bank like the Federal Reserve in the US and the European Central Bank in Europe set interest rates to control economic activities. These rates are crucial because they influence the flow of capital into out of a country. So higher interest rates offer lenders, such as banks and investors, a better return on their investment compared to other countries. This makes the country's financial asset more attractive to foreign investors seeking higher returns. As a result, higher interest rates attract foreign capital. Investors buy the country's currency to invest in its asset, which increase the demand for the currency. This increased demand caused the exchange rates of the currency to rise. In simple terms, when a country raises its interest rates, its currency becomes more valuable relative to other currencies.
So hi, now I'll talk about inflation rates. It have a big impact on how strong or weak a currency is on the global market. So here are the 5 ways inflation changes exchange rates. The first one is a purchasing power parity. It said that a currency should change so that a group of things costs about the same amount in all countries. The second one is inflation currency value. When a price rises, the value of currency falls. This also makes the currency weaker in other countries. Imagine that your home country currency is worth less because you cannot buy as much with it. It lost a value against currency that have lower inflation. And the third one, relative inflation matters. The exchange rate affected by how much inflation there is a different country. Example, inflation rate in country A has a 2%, meanwhile the country B has 5%. So country A currency tend to gain value compared to country B currency. So this next one is a currency strength and investment. Foreign investment can come to a country with a strong currency because it allows lower inflations. Investors want to put their money into a currency that are stable and have strong currency. And the last one, exchange rate volatility. When inflation is high, exchange rate can change a lot. The foreign exchange market goes up and down because unpredictable price rise that make it hard to figure out what currency is really worth it. So as a conclusion, we can say that inflation has a big effect on exchange rate. It changes the value of money, the rate of inflation between countries, the flow of investment, the instability of the exchange rate, and even the actions taken by central bank. Businesses and people who deal with the foreign trade in finance need to understand this relationship. The foreign exchange market is always changing, but if you keep an eye on inflation trend, you can make a smart choice about how to swap currency.
My name is Muhammad Ahmad and I'm going to continue with political stability and economic performance. And the main point here is positive impact of political stability on economy. And the first one is attract foreign investment. Investment are more likely to put their money in a country with a stable political environment. And this is because political instability creates uncertainty which can discourage investment. And the second one is increased economic growth, which is political stability allows businesses to plan for the future without fear of sudden disruptions, and this can lead to increased investment and economic growth.
Assalamualaikum warahmatullahi wabarakatuh. I'll be explaining about public debt. Public debt refers to the money the government pays to cover its spending. There are 2 main types of lenders, domestic and foreign. Domestic lenders such as banks and pension funds are the main type of lenders in the country. Foreign lenders, on the other hand, are those from other countries. The government use bonds and other securities as a means to borrow money, which the promise to pay back the loan with interest at a later date. The maturity date of a bond is the date it must be paid back, and the interest rate is the amount an owner receives annually from a bond. Factors affecting the interest rate include the government's creditworthiness, the bond's due date, and the overall interest rate level in the market. The amount of state debt can be affected by various factors, include the rate of interest, investor confidence, the type of debt, and borrowing methods. high interest rates can cause the government to pay more to borrow money, while low investor confidence can encourage the government to borrow more money. The type of debt and borrowing methods also impact public debt. Short-term debt may require the government to borrow more frequently, leading to higher interest rates over time. Overall, the government use of public debt and borrowing method can significantly impact its financial stability and ability to meet its spending needs.
Hi, Assalamualaikum. My name is SYAHIEZY PUTRI binti YAHAYA, and today I would like to explain to you about trade balance. Trade balance refers to the difference between a country's exports and imports of goods and services. It is a crucial indicator of a nation's economic health and can significantly impact its currency value. Trade supplies occurs when a country exports more than it imports, generally leads to a stronger currency. Foreign buyer must purchase the exporting country's currency to pay for its goods and services, increasing demand for that currency. For example, Japan often has a trade supplies contributing to the strength of the Japanese yen. The second one is trade deficits. Trade deficits occurs when a country imports more than it imports. Trade deficit can weaken the currency. Domestic customer needs to buy more foreign currency to pay for imported goods, increasing the supplies of their own currency in the foreign exchange market and reducing its value. For example, the United States frequently runs trade deficits, which can put downward pressure on the US dollar. In summary, a trade surplus tends to strengthen a country's currency due to a higher demand from foreign buyers, while a trade deficit can weaken the currency due to increased demand for foreign currency by domestic consumers.